All right, let's dive right into Warren Buffett's 2019 shareholder letter. We're not just going to summarize it, we're going to break it down and pull out the key frameworks, the mental models that you, as a professional investor, can actually use in your own work. Let's get to it.
Okay, let's just start with this number, because really it says it all. This isn't just some return, it's the result of a whole philosophy. A gain of over 2.7 million%. I mean, it's an almost unreal figure. And figuring out how they did it is exactly why we're digging in today.
So, how do you get a number like that? Well, it's not from one lucky home run. It's from patient, methodical compounding. As you can see here, Berkshire's annual gain didn't just beat the S&P 500, it more than doubled it. Every single year, on average, for over 50 years. That's not luck, that's a system.
So what's the first rule in the Berkshire playbook? Well, funny enough, it's not about what to look for. It's about what you need to learn to ignore. And a lot of the time, that's the headline number that everyone else is focused on. Just look at this. It's wild. GAAP earnings went from $4 billion to over $81 billion in 1 year. Now, did the actual value of Berkshire's businesses multiply by 20 times? No way, of course not. This is a classic accounting illusion, and it's all driven by a new rule that forces companies to report the daily swings of the stock market in their net income. For an analyst, this is pure noise that hides what's really going on. And this, right here, is the first core principle for us. Buffett tells you point blank, focus on operating earnings. This is a critical filter we have to apply. We need to just strip out all that market volatility, the paper gains and losses, to see the real economic engine underneath. The real story is in the operations, not the stock market's mood swings. So, if we're supposed to ignore the GAAP fantasy number, what's actually real? Well, Buffett points us to two fundamental engines that have been powering this whole compounding machine for decades. The first engine is retained earnings. And, this is a concept a lot of investors just kind of gloss over. It's not just the profit a company makes, it's the profit it keeps and reinvests to make even more profit down the line. You can think of it like a hidden compounding machine, humming away inside the business, totally separate from the daily stock price. And this chart just lays out that hidden value perfectly. Look at the numbers. In 2019, Berkshire's operating earnings officially included about $3.8 billion in dividends from these companies. But the real story is over in the right-hand column. Those same companies kept over $8.3 billion of Berkshire's share of the profits. That's a massive amount of capital being reinvested to grow the businesses, and it's completely invisible on the income statement. Now, Berkshire's second engine is the financial magic of insurance float. What is that? Well, it's basically a giant, and I mean giant, interest-free loan from their policyholders. See, Berkshire collects all the premiums up front, and then they get to hold on to that cash, sometimes for years or even decades, before they have to pay out any claims. And in the meantime, they can invest all that money for themselves. And the scale of this thing is just mind-blowing. This chart shows the float growing from about $39 million back in 1970 to almost $130 billion today. This isn't dead. It's a constantly regenerating river of capital that gives Berkshire all the firepower it needs for its investments. And here's the real kicker, the masterstroke. For most insurance companies, float has a cost, but Berkshire is so disciplined with their underwriting that they almost always make a profit on it. Their premiums are consistently more than their expenses and claims. So their cost of capital isn't just zero, it's negative. It's like taking out a huge loan where the bank actually pays you interest. It's incredible. Okay, so we've got these two incredibly powerful engines, retained earnings and float. Now let's look at how Buffett actually deploys that capital. He uses two different ways of owning businesses, and understanding the accounting difference between them is absolutely crucial to valuing the company correctly. This slide is key. On the left, you've got the businesses Berkshire actually controls. 100% of their earnings flow right into Berkshire's operating earnings. Simple. But on the right, with that huge portfolio of stocks, only the dividends get counted. Remember that $8.3 billion in retained earnings we just talked about? Poof! It's completely gone from the income statement, which creates this huge blind spot for anyone doing a standard analysis. And his rules for buying a business, whether it's the whole company or just a small piece, are famously simple. This isn't about some crazy complex spreadsheet model. It's a powerful, common-sense framework that just boils down to three things. Is it a good business? Is it run by people you can trust? And can you buy it at a fair price? All of these principles, they all tie back to this one central philosophy, the owner's mindset. And this is probably the single most powerful lesson in the whole letter. It's about that mental shift from thinking like you're just renting a stock to thinking like you actually own a piece of the business.
This quote just says it all, doesn't it? He doesn't see tickers and market prices. He sees an assembly of companies. He is mentally looking right through the stock certificate to the underlying business itself. And in this case, that business is earning a fantastic 20% on its capital. He's focused on how the business is doing, not how the market is feeling.
And because he thinks like an owner, it's no surprise that he has some pretty harsh words for corporate governance. He sees a huge disconnect on a lot of boards, where directors are more interested in getting along and collecting a paycheck than in actually representing the shareholders. As he famously said, CEOs aren't looking for pit bulls in the boardroom. They want Cocker Spaniels.
Even his approach to stock buybacks is filtered through that same owner's logic. For him, it's not some trick to juice the earnings per share number, it's just a straightforward capital allocation decision. The test is simple. First, are we buying our own stock for less than it's really worth? And second, will we still have plenty of cash left over? That's it. It's just business logic.
Finally, Buffett gets to the question on everyone's mind: succession. How does this massive enterprise not just survive, but thrive after its founders are gone? He spends the last section of the letter making the case that Berkshire is truly built to last. I mean, this quote from his wow. It's maybe the ultimate statement of conviction. He's not just a buy and hold investor, he's a buy and bequeath investor. By literally forbidding his estate from selling, he's making this huge, multi-generational bet on the enduring value of what he's built. And he argues he can make that bet because the company rests on these 5 pillars. It's a powerful mix: great businesses, a rock-solid balance sheet, and, what's maybe the most important part, a deeply ingrained, owner-focused culture that he believes is the real secret sauce that will outlast any one person. So we'll end by turning that same question back to you, because it really gets to the heart of this whole letter. What level of conviction, in the business, in the management, in the culture, would it take for you to tell your heirs, whatever happens, do not sell this investment? Answering that question for yourself, that's the final step to truly adopting the owner's mindset.